What's up, everybody? Welcome back to Brofolio. Today's tape did the opposite of what it was supposed to do. April Producer Price Index just printed 6% year over year, hottest wholesale read since December 2022, and the Nasdaq closed at a fresh all-time high anyway. Cisco crushed earnings and ripped 17% after the bell. Alibaba's AI cloud business grew 38%. Oh, and oil sold off 2% even with lower US inventory than expected. None of that was supposed to happen on the same day. Let's break it all down. First on the clock, PPI. April headline producer prices came in at 6.0% year over year, absolutely obliterating the consensus estimate of 4.9. Month over month came in at 1.4, nearly 3 times the expected number of 0.5. This is the biggest monthly jump since March of 2022. Core PPI, which excludes food and energy, was up 1% on the month and is now at 5.2% year over year. Both core and headline are at 3-year highs. The driver? Gasoline prices were up over 15% on the month at the wholesale level. That's the Iran war leaking into the producer chain. Yesterday, it was at the consumer pump. Today, it showed up higher at the producer pump. This will not be the end of the inflation storyline this year. The bond market noticed first. 10-year Treasury yield closed at 4.48%. It touched 4.49 intraday, and it's marching fast on the doorstep of 4.5. The 30-year bumped the 5% line again, closing at 5.05, and the 2-year held around 3.99. The probability of a rate hike before the end of 2028 is up around 27%. And Bank of America just told clients expect no rate cuts until the second half of 2027. Now let's recap how the markets actually closed after all this bad news. The Nasdaq closed up 1.2% at 26,402, another new all-time high. S&P 500 went up 0.58% and finished 7,444, also a new high. The Russell 2000 finished essentially flat at plus 0.04, and the Dow finished red, down 0.14, and the volatility index dropped under 18. Let's read that again. PPI prints 6% year over year, and the Nasdaq and S&P finishes at new record high. Also, the fear gauge somehow retreats. Let's look closer at who actually did the heavy lifting. Google was up 4%, and Meta, Nvidia, and Tesla had themselves 2% days. The losers, commercial services down 2.6%, and Altides down 0.89. And here's the weird one. Energy was down 0.1 on a 6% PPI day. That isn't normal. Energy normally rips on hot inflation. Today it sold off because oil sold off. WTI closed down 1.15 at $101. Brent down 2.06 at 105.55. Also, US inventories printed twice the expected draw today, and crude still sold off. The market is trying to fade the oil spike, but the same spike just showed up in the inflation prints this week. Now let's look at why tech ripped through a hot inflation day. Nvidia's market cap is now $5.52 trillion. That is bigger than the market cap of every silver bar on the planet. One chip stock. Bigger than every ounce of silver ever mined. Hold that picture in your head. Cisco reported after the close today. They saw revenue at $15.84 billion, up 12% year over year. But here's the line that moved the stock 17% in after hours. CEO Chuck Robbins said total product orders rose 35% year over year. Networking orders jumped more than 50%. And most importantly, data center orders climbed over 40%. Additionally, they doubled their fiscal 2026 AI infrastructure order forecast, from $5 billion to $9 billion in one quarter. Cisco also announced 4,000 layoffs as part of the AI restructuring. That's 5% of their headcount. They are now joining the club of large tech companies firing workers to fund their build-out. Additionally, today, McKinsey reported they believe that $5 trillion of spend will go to AI data center builds by 2030. Cisco doubling of their slice of that pie in one quarter is the exact bull case for AI spending and growth that is causing hot inflation to get buried under this rally. Oh, and the AI story isn't just American. Alibaba reported its March quarter. They missed revenue by $4 billion, its first operating loss since early 2021. But AI and cloud revenue grew 38% year over year. The CEO said annualized AI recurring revenue will pass 10 billion yuan in the June quarter and 30 billion yuan by year end. Tencent also had a similar story of AI overspending, with them having their slowest revenue growth in over a year. But marketing services were up 20% and international gaming up 13%. Both Chinese hyperscalers are spending hard on AI, and the market is paying them anyway. It's looking like it will be the exact same trade as the US megacaps. Going back to bonds, the US 30-year bond auctioned at 5.047%. First 5% long bond at auction since 2007. The Japan 10-year and UK 30-year are still parked at the highest levels century. Three of the biggest sovereign curves are still at decade-plus highs. And underneath all of that, the consumer is cracking. 13.1% of credit card balances are now 90-plus days delinquent, highest since 2011. And auto loans are at a record as well. Main Street remains stretched thin at the bottom. Moving on to metals and currencies. Silver ripped 3% to 88.15. Copper up 1.35% at 662. Platinum was up nearly 2%. And gold stayed pretty much flat at 46.97. DXY up 0.17 to 98.47. Bitcoin was red, under 80,000 at 79,414, down 1.43%. And Ethereum was down 1.31%. The whole risk asset complex caught a bid except crypto and oil. This is a tell about where the inflation hedge is actually currently parked. Tomorrow morning, the catalyst is jobless claims, which will be released at 8:30 a.m. Eastern Standard Time. After last week's print, anything above 250,000 and the soft landing crowd starts getting nervous. We also get April retail sales, and with PPI this hot, retail sales will be a real demand check. If consumers are still spending, the show will continue to go on. If they're not, the slowdown call will get a whole lot louder. On Friday, we get the University of Michigan sentiment print, and it will include the 5-year inflation expectations. After today print, this report matters a whole lot more than normal. In the background, we have the Trump-Xi summit. 12 of the biggest US companies' CEOs flew to Beijing with Trump. But what is out of the ordinary is the state media in China hasn't mentioned the visit at all, and expectations for the summit just got downsized to a low-impact stability meeting. When the host country won't even acknowledge you're coming, that's the tell. One last thing I want to mention is the performance of the global indexes since the US-Iran war began. With the huge macro shock that has occurred since the closure of the Strait of Hormuz, you think markets would be hurting. Actually, quite the opposite. The Kospi is up 22%, Nasdaq up 17%, Nikkei is up 7%, and India and the UK are the only major markets still red. The global tape keeps ripping right through a war, but underneath that ripping tape, the dollar's share of global FX reserves is at the lowest level this century. The auction at 5%, the reserve share falling. These are things that will catch up to us in the near future. Now I want to leave you with this. Episode 1, we talked about the rhyme, 1999, megacaps carrying the index. Episode 2, the bond market repricing. Today, we added a new verse. The hottest wholesale inflation print in 3.5 years showed up, and the Nasdaq finished at a record. Cisco doubled its AI guide. China's AI cloud grew 38%. Oil sold off. JP Morgan says the buy side is quietly turning bearish while the index hits an all-time high. This is exactly what late cycle melt-ups look like. The data screams hot, the mega caps grab the mic, and everything that's supposed to break doesn't. Yet. Really make sure to pay attention to the gap between what the data says and what the tape does. The gap between mega cap order books and Main Street delinquency rates. Because historically, those gaps close. The question is, which side closes?